All right, people are starting to, still working their way in from the lobby. I understand how much fun it is to be in person for a change, and so the social dimension of these events is always a highlight. But we'll go ahead and get things started. Thank you all for joining us today, both in person and on the web. I'm Mark Finley. I'm the Fellow in Energy and Global Oil here at the Center for Energy Studies at the Baker Institute. We've lived our whole lives in the age of oil. Oil is by far the world's leading source of energy, and it has been for almost all of our adult lives. It's been, however, a century since oil really took off, after a period of explosive growth that brought it to its dominant position, turbocharged, if you'll allow me to use that pun, by, on the supply side, large discoveries that were very cheap and prolific here in Texas and in the Middle East, but also on the demand side, with the advent of personal automobiles, driven by the internal combustion engine and manufactured cheaply and at scale on Henry Ford's assembly lines. Oil's rise has been accompanied by dramatic advances in our quality of life. Global per capita GDP, per capita income, is about 10 times what it was when Colonel Drake drilled his first well in Titusville, PA. Here in the United States, the advance has been even more dramatic, about 15 times. And in today's current environment, I should note that that was after adjusting for inflation, by the way. But this progress hasn't come without cost. Development of oil and other fossil resources has a significant history of environmental degradation, polluted air and water, large-scale social disruptions, and lives lost in industrial accidents. The search for fuels and technologies to continue the upward trend of human development without its historical costs is not a new one. Indeed, it's been at least 4 decades since Sheikh Yamani referred to the end of the age of oil, with his joking reference that the world didn't run out of stones to cause the end of the Stone Age. And today the focus is on CO2. Atmospheric concentrations of this gas are 50% higher than they were when Colonel Drake drilled that well. And that growth of CO2 emissions and atmospheric concentrations is driving a more energetic search for new energy sources and technologies. Collectively, these ongoing and prospective changes are frequently referred to as the energy transition. What does all this mean for the future of oil, which is today nearly 1/3 of all of the energy the world consumes? Will our kids and grandkids only know about this age by studying their history books, if books are something that still exists for them? How does this play out? EVs are coming, but how quickly? If oil demand does begin to contract, which producers will survive the competitive game? What are prospects for biofuels or hydrogen? Will CCS, carbon capture and storage, allow for continued large-scale use of oil and other fossil fuels? What role will today's companies play in this process? And what kind of changes are likely in regard to public policy, technology, and personal behaviors and preferences? Today, the Center for Energy Studies is launching a new initiative on oil in the energy transition, aimed at exploring these questions and many more. And I can't think of a better way to launch this initiative than today's program. Today, we're fortunate to be joined remotely from Paris by Tim Gould, Chief Energy Economist at the International Energy Agency and co-lead author of the IEA's influential World Energy Outlook. The scenarios developed by the IEA and the related analytics have played a key role in shaping the global discussion of the world's energy future, including at the recent COP26 in Glasgow. After Tim spends about 20 minutes walking us through the oil dimensions of the IEA's long-term scenarios, we'll get commentary from my colleague here at the Center for Energy Studies, Ken Medlock, as well as Bobby Tudor. You all know Ken and Bobby, and I won't recite their bios to you, don't worry. You can find them on our website. But I would like to note that among his many contributions to our industry, Bobby Tudor plays a leading role, indeed the leading role, in the Greater Houston Partnership's own initiative on how the world's energy capital can continue to play a leading role in this energy tradition. And we'll do all that in time to also engage with conversation with you and to hear your questions. So, Tim will speak for about 20 minutes, and then we'll get brief commentary from Bobby and from Ken. We will invite the audience here in person to submit questions on the notepads that are available. For people joining us online, you may put questions in the chat function, which we'll be monitoring and also passing those questions up to us for the moderated Q&A. And we'll do all of that and have you out of here in an hour. So, without further ado, Tim, the floor, at least electronically, is yours.
Thank you ever so much, Mark. It's a huge pleasure to join you today. I'm going to try and share my screen here with some slides that I hope will allow me to walk through the topics that you've just very nicely outlined. And I'd like to start with some old Economist covers, which shows that the debate that we're having now is really not a new one. The cover on the left it dates back all the way to 2003, when the Economist concluded that advances in technology are offering a way to loosen the grip of oil. Hydrogen fuel cells and other ways of storing and distributing energy are no longer a distant dream, but a foreseeable reality. Interestingly, the solutions that were challenging oil, at least in the perception of the Economist back in 2003, were hydrogen followed by biofuels. No mention at the time of electricity. We move on 10 years for the middle headline, the middle cover, and then the Economist concluded that the IEA, amongst others, predicts that demand will keep on rising. We believe that they are wrong and oil is close to a peak. And that was due to shale gas in particular, and second, because of technology, the efficiency of the internal combustion engine, although growing popularity of electric and hybrid cars sort of entered the picture this time. And the cover on the right is from 2019. I could have chosen many different ones there, but it concluded then that a new chapter in the oil story is unfolding, the prospect of stagnating or falling demand as the world shifts to cleaner energy. And yet, throughout this period, with the exception, of course, of 2020, demand has continued to grow. As we speak, oil demand is heading upwards and back to pre-crisis levels, probably sometime next year, according to our near-term IEA analysis. So this time clearly needs to be different, as the IPCC and the Glasgow Climate Pact and any other pieces of climate-related analysis show. But will it be different? How quickly will it be different? And what is changing in practice? And that's what I wanted to explore in these brief remarks for you today. I'm not going to dwell much on the near term, but it just so happens that a new oil market report came out this morning. So I wanted to highlight just a couple of points from that. We do have lingering impacts from the pandemic. We're probably never going to get back to that pre-pandemic trajectory. But in the absence of major policy changes from governments, more rapid deployment of alternative technologies, then global oil demand is set to increase, in our view, at least for a few more years. There's a lot of uncertainty around the health implications of the new Omicron variant and how governments and households will respond to it. That's obviously a big uncertainty for the near future. But for now, we do expect that the surge in new COVID cases to slow but not derail the recovery in oil demand that is underway. And if you look at the product by product dynamics, this is all in comparison to where we were in 2019. The elements that show continued growth, mainly petchem feedstocks, that's a near-term story about the exceptional polymer demand related to the production of medical equipment and protective gear. But there's a longer-term growth story there for petrochemical feedstocks, where we are short of 2019 levels is, of course, in jet fuel, but also gasoline, where we see the strongest evidence of structural change. And I wanted to zoom in a little bit on the transport sector, in particular to deal with how are things changing with the growing popularity and rising share of sales for electric vehicles in different markets. So as of the end of 2020, there were about just over 10 million electric cars on the road worldwide, and battery electric vehicles were about 2/3 of that total. Around half of that total stock of electric cars was located in China. However, Europe experienced the largest increase in 2020, and that strong momentum continued well into 2021. Some of the latest sales numbers for EVs are extremely strong. Note, however, the sales of electric cars are strongly concentrated in markets with supportive policies. Very meager picture outside Europe, China, and parts of the US. And that's related to policies. It's also related to the rollout of infrastructure. So in our view, at the end of last year, 1.3 million publicly accessible chargers are available worldwide. More than half of those are in China. And so one of the big questions then for the future is how quickly does that rapid progress amongst the front runners turn into something that you can see in other markets as well. We have to be aware that electrification, much broader than cars, actually the most electrified area segment of road transport is 2- and 3-wheelers, and that's especially noticeable in many developing economies. So in 2020, sales of around 25 million electric 2- or 3-wheelers, that's 10 times more units than cars, and almost 1 in every 3 vehicles in that segment was electric. And they have quite compelling economics. And unlike some other modes, they can cope also with weak electricity networks. That's not, of course, the full story. There's been some progress also in the deployment of electric vans, buses, heavy trucks are much smaller. But we do have a very strong level of geographical concentration also in these markets, with China really dominating much of that. So that's all I'm going to say about the starting point. And now I'd really like to look at how these things play out in our scenarios. And I'd like to sort of introduce our scenarios briefly to you. Now, this was this slide is all about emissions. So it's the energy-related CO2 emissions history and projections. And this is where we had global emissions going prior to the Paris Agreement. Things have changed since then. So our read on where today's policy settings lead us now shows a flattening of global emissions over the coming decades. A stabilization in global emissions, though, is a very long way from a stabilization in global temperatures. But what we wanted to do, particularly in view of the COP26, was examine what happens if you give governments the benefit of the doubt and assume that all those pledges that you heard about in Glasgow would be implemented. And that's what we analyzed in something we called an announced pledges scenario. We updated that during the COP26 meeting because there were important new announcements made at COP, notably from India. And so what you have, if you believe what governments say, then you do get an important parting of the ways between economic growth, which continues, global energy demand, which flattens, and energy-related CO2 emissions, which fall. And we haven't seen that parting of the ways since the start of the Industrial Revolution. We are, though, even with all those pledges in place, quite a long way still from what would be required to get us to a net zero by 2050 scenario. So in the slides that follow, I'm going to look at different scenarios for oil, one of which is based on a bottom-up look at what's actually in place today and what are governments actually doing. That's the stated policy scenario. I'm also going to look at what happens if they do all the things that they say they're going to do. So all of these 2030 nationally determined contributions and the longer-term net zero pledges. And then I would look in the third scenario at what it would take in order to get us to a 1.5 degree stabilization. The first two of those scenarios are exploratory in nature. So they fix some starting conditions and then see where we go. And the last one is normative in the sense that it fixes the endpoint and works out how we get there. And here's the broad picture for the oil demand and supply associated with each of these scenarios. So a flattening in oil demand and in that scenario based on today's policy settings, a relatively rapid peak, so sometime in the middle of the 2020s, if you believe all of those announced pledges, and then we're down to approaching 75 million barrels a day if all of those announced pledges are met. But then there's still a huge gap with what is required in a net zero emissions by 2050 scenario. And you see some interesting variations also on the supply side, particularly in the rising share of supply coming from some established producers, notably in the Middle East, the faster you go through energy transitions. I'm going to take each of these scenarios in turn and look in detail at the stated policy scenario. So a reminder, that's the one based on the policies that we actually see today. And I'm looking here at total final consumption. So this is the consumption that consumers around the world in industry, buildings, and the transport sector account for. So it doesn't include, for example, the way that electricity is produced. And the logic of looking at the whole energy system here is that you can't understand oil in isolation. You need to put it in context to see how that demand for those energy services is met in other ways. And you can immediately see with this slide what the real challenge is for energy transitions. Transport fuels may no longer be a sort of reliable motor for growth in oil demand, but transport in that scenario is still a sort of reliable stronghold for oil consumption, and therefore also a major source of emissions. So the oil use for passenger cars declines gently in that scenario, despite steady growth in the international vehicle fleet, especially coming from developing economies there. But oil use in heavy trucks, from aviation and shipping, much more difficult to shift. There's also a steady increase in this scenario in the oil use for petrochemicals. So we have a gradual increase in the share of plastic waste that is collected for recycling, but that's not enough to offset increased consumer demand for packaging and other petrochemical outputs. What happens then if we give governments the benefit of the doubt and we say they are going to hit all of those targets they've been talking about? This is then the picture. In some ways, it's a difficult multi-speed world. Some countries move ahead with transitions much more rapidly than others. And so we have a marked shift in the geography of oil demand towards selected emerging and developing economies. There's a much stronger drive to electrify transport and backed up by much stronger policies on infrastructure, including bans on the sales of internal combustion engine vehicles in many countries. So already by 2030, so within the next 10 years, in countries with net zero pledges, 50% of all cars sold are electric, and that's very much in line with the target that has been announced by the current administration in the United States. We also see much more rapid changes in some of the other sectors as well. So over 20% of the heavy trucks sold in countries with ambitious pledges are electric or fuel cell by 2030. And that, of course, helps to bring down consumption in that sector. But again, aviation, shipping, much more tricky. Finally, what happens in that net zero emissions by 2050 scenario? You have that complete transformation, that very rapid ramp up in clean energy technologies, precipitating a very rapid fall in oil demand. And what does that mean? It means already by 2030, 60% of the cars sold worldwide need to be electric. There's only one country basically that has managed that so far, and that's Norway. So essentially every country needs to be by 2030 where Norway is today in terms of electric vehicle penetration. But extremely rapid changes in other sectors as well. Electricity coming to dominate the road transport sector, supported by hydrogen and hydrogen-based fuels, especially for long-haul heavy-duty trucks. In shipping, energy efficiency plays a role early on, advanced biofuels and hydrogen-based fuels coming in a bit later on. Of course, there are question marks about how far and how fast things can change, and that's reflected really in the dilemmas that face suppliers in these scenarios. So if we look at what that means for the supply side, there is quite substantial new field investment required in the stated policy scenario. That falls substantially if all of those announced pledges are met. But the decline in oil and gas demand in that net zero emissions by 2050 scenario is, as many of you may be aware, it's sufficiently dramatic that the demand in those scenarios can be met just by continued investment in existing and approved fields. I wanted to conclude with a look at how today's investment trends stack up against that scenario analysis. I think we're all aware that upstream investment has fallen quite strongly over recent years. It's roughly half of where it was in 2014. And one of the striking findings in our analysis this year has been that the amount being spent in the upstream today is broadly compatible with the amount that we have in that net zero emissions by 2050 scenario over the period to 2030. What does that mean? It means that the upstream investment seems to be geared towards a world in which demand for oil, demand for gas is at best sort of stagnant and then probably declining before long. Now, that's not the world that we see when we look out the window. That's not the world that we see in our near-term market analysis. And on the other side of the ledger, you have the picture for clean energy and infrastructure investment. Now, that's been much more resilient than investment in the upstream, and it's increasing again this year. But it is far short of where we would need to be in order to secure that transition to a 1.5 degree world. And so you would need to see investment ramping up across a wide range of technologies and a wide range of geographies, with the deficit particularly strong in many emerging and developing economies, in order to get us to that kind of outcome. Now, policymakers are very focused on getting us towards that 1.5 degree stabilization. And what that means is that we have to see that the way out of this impasse has to be a strong increase in spending on energy transitions. But for as long as the imbalance that you're looking at on the screen exists, there is the risk of a bumpy ride. There's a risk of future market volatility and price swings. So I guess my concluding thought to you all would be the IEA's scenarios are full of nice smooth curves and straight lines. But I think our expectation should also be extremely aware that there is the potential for this to be a disorderly process, a disorderly transition. We have to do everything we can to avoid it, but that risk is certainly should be uppermost in our minds. And with that, I would conclude these introductory remarks, very much looking forward to hearing the comments from our distinguished panelists and then the questions from you all.
Tim, thank you very much for the great overview of the IEA's scenarios and related issues. For that, let's next turn to our panel. And Bobby, why don't you kick us off?
Great. So I think I'll start with where Tim ended, which is on the capital front. He showed that the IEA sort of projected investment needed for the net zero scenario is about $3.25 trillion per year over the period. And that would compare, for example, to in 2014, the incumbent oil and gas sector spent about $900 billion. That was the all-time high for capital expenditures in the incumbent sector. So we're suggesting 3 to 4x that number every year for quite a long time to get to a net zero number. And so while we're spending about $1 trillion a year this year, you would have to ask, where is that incremental 2 to 3 trillion per year going to come from? And I think that's the rub at the moment, because many of the technologies required to get to a net zero scenario are simply not developed enough to attract private capital in the amounts needed. Traditional private capital would look for at least double-digit returns to justify the risk associated with it. And many of these technologies, it's more venture capital in nature, and so the capital would seek returns much higher than 10 or 12%, or probably closer to 20%. And we simply don't have technologies today that would really attract enough capital on those sort of risk-return scenarios. So if you say, well, there's not enough private capital to get there, will there be enough public capital? And public capital, of course, is a euphemism for government money, and government money is a euphemism for taxpayer money. So either in the form of higher taxes or in the form of higher cost to consumers, there is going to need to be massive wealth transfer in that regard to meet these scenarios. And that's where the rub comes in my mind, which is that thus far, all the talk around incremental capital deployment to the sector has been around the supply side, and really not from the demand side. And my view is that's because the politics around the supply side are much easier. It's relatively easy politically to demonize oil companies, for example, as being kind of responsible for both the problem and the solution, than it is to put the burden on the actual consumer, particularly in developing countries. And so I think until that circle gets squared, we're likely to be in a scenario of continuing to be short multiple $1 trillion of capital per year to meet anything close to the net zero goals. Now, so where might there be a glimmer of hope? In my mind, it would be around carbon capture, use, and storage. I think the policymakers and political leaders are slowly getting their heads around the fact that completely replumbing the world's energy systems away from all things fossil fuels and towards all things non-fossil fuels is simply too expensive. And thus technologies which actually are increasingly economic that can be used to capture CO2 emissions at the point source will become increasingly attractive, and I'm very bullish on the future of that technology and the role that it will play ultimately in decarbonizing, particularly heavy industry, which is obviously a large component of our CO2 emissions. So, like many things in life, it all comes down to money, and stated policies are great and ambitions are great, but at the end of the day, the vast majority of those actually do require capital. And one of the things we know about the energy business is it is a highly capital intensive industry. It always has been. It will continue to be that. And the money has to come from somewhere. So that's what I would say I'm keeping my eye on more than anything else.
Thanks, Bobby. And in relevant to your comment about the newness of the technologies needed, Tim may wish to add more detail when we come to it, but the IEA has recently published a technology update saying that half of the technologies needed to achieve the net zero technology are not yet commercially viable and need that exact venture capital type of engagement to progress. Ken?
Yeah, so I'm going to echo in many ways a lot of what Bobby said, but I want to start with a slide that I thought was really clever that Tim showed, which was the pictures of the different covers of The Economist. And I'm gonna one up it because I actually use this in my energy economics class. There's a cover, and you guys should all look this up, of Popular Science back in April of 1981 that echoes exactly what Tim was talking about on the cover of The Economist. And it really speaks to a desire or an ambition to move away from oil. In 1981, of course, the motivation was energy security, right? It was very front and center. Everything's changed in terms of motivation. It's not just about energy security now, it's also about the environment. But it's interesting when you go back through time and you see these predictions that consistently are aiming at a reduction in the use of oil, and we consistently see those predictions fall short. And so at some point you have to take a step back and say, well, why are they always wrong? And I think that's a useful exercise in thinking about where we might be going today. It doesn't mean they will always be wrong, it just means looking back they've always been wrong, right? At some point, you know, what's the statement, a broken clock is right twice a day, right? So at some point you're going to get it right. And then coming from somebody who's actually done a lot of modeling and forecasting, believe me, I'm sympathize with that in many ways. But the one thing that I always come to is when you think about transitioning anything, not just energy systems, anything, it really ultimately boils down to integrating new technologies into an existing set of supply chains or an existing ecosystem. And the energy ecosystem is incredibly capital intensive. It's not like telecommunications. It's not as simple as moving away from wires and installing cell phone towers and getting individuals to buy a different handheld, right? It's not capital that lives in your pocket for 1, maybe 2 years before you turn it over for the next great iPhone or whatever it is that comes out. You're talking about long-lived capital infrastructure. So when you get to a point where you're discussing integrating new technologies, those technologies are often more successful if they can integrate with existing infrastructures. And so this comes really front and center in any context of energy transitions. When you talk about replumbing the entire energy ecosystem, that gets very expensive because you're talking about tearing up all of the existing infrastructure and replacing it. And you got to realize the existing infrastructure has taken decades to be put in place. It didn't happen in 10 years. It didn't happen in 20 years. It happened over a period of 50, 60, 70 years. And when you look out beyond where the existing infrastructure is, the other thing we have to realize, and this is really a question of scale, about on the order of 3.5 billion people of the total world population has inadequate access to modern energy services. About 1 billion have no access at all. And so now you're talking about trying to overcome those challenges as economies grow and at the same time transition the system. It's a massive undertaking, without a doubt. And that's where I think the capital question comes front and center, because not only are we talking about now replumbing the entire system, we're also talking about doubling its size. Because if we go out to 2050, you're talking about 9.6 billion people. That's not a small feat. So in many ways, I think as we look forward, if we're going to remain positive about this, I think we need to do so with an eye towards leveraging existing infrastructures. And so that's where carbon capture comes into play. That's where hydrogen comes into play. A lot of the things that people are discussing now, I think, have a very bright future. I think everything has a bright future, but the one thing you have to remember is it's not just about the cost of delivering an electron. It's not just about the cost of generation. It's not just about the cost of the fuel. It's actually also about the cost of developing the supply chains to support that delivery. And that's where the capital intensity grows dramatically. Last thing I'll say, and this is along the same lines, and I mentioned this to Bobby before we even started, I said the one thing that always I come back to is when you look at the history of investments in the energy space, there are very few investments that have actually delivered on time and at cost. And so when we look at these scenarios where we're talking about meeting certain targets, it's like we've forgotten all of that, right? There are inevitably hiccups that occur along the way, things that disrupt the development of projects as we move forward. And I don't think that the next 30 years is going to look any different in that regard.
One other point, Mark, I would add quickly is that sort of popular perception, and to some degree, not just popular perception, but perception of the ruling class, is that if the super major oil companies would just do the right thing and redirect their capital away from hydrocarbon exploration and production and toward cleaner forms of energy, then we could solve this problem. And that's just fundamentally untrue. The total capital budgets of let's call it the 7 super majors, I'll just pick a number, it kind of depends how you define a super major. The total capital budgets of that group is less than $150 billion. So even assuming for the moment that Shell, BP, ExxonMobil, Total, Equinor, ConocoPhillips, you name it, they all took 100% of their capital budget and moved it away from fossil fuels and towards non-fossil fuel investment. That would be a total of $150 billion. Well, you just heard that we're currently spending about 1 trillion globally, and we need to spend about 3.5 trillion globally. Well, if those companies did that, 1 trillion would go to 1.15 trillion and would still be $3 trillion short. So this notion that the solution rests in the hands of the super major oil companies is a fundamentally misplaced notion. And once again, in my mind, it comes back to politics. It's easy to hate super major oil companies, and no one likes it when they're paying more at the pump and they want to blame someone, and the easy person to blame is your retailer. But the fact is, the capital required for this transition is just mind-blowingly large, and no one sector, super major oil companies included, can be the solution alone.
Thank you to both of our panelists. Tim, is there anything from Bobby's or Ken's remarks that you'd like to respond to briefly before I move into some Q&A and discussion?
And I mean, many thanks to you both for those comments. I mean, very insightful. I mean, certainly agree that we are moving towards a more capital-intensive energy system. And in fact, one of the distinguishing features of that new energy economy, if you can call it that, is that it is distinguished by technologies in many sectors that have significant upfront costs, but then very low marginal costs, very low operating costs. And that means, of course, that the share of financing costs in the overall picture, or the importance of financing costs, becomes an incredibly important variable for the prospects for success. I mean, we've had a period of where capital has been very cheap in Europe and in the United States, but it's up to 7 times more expensive to the cost of capital in many developing and emerging economies. And that is a very significant obstacle then to the sorts of changes that we want to see. And so I think what's one of the areas that we're increasingly looking at and increasingly concerned about is how do you bring down the cost of capital for these kinds of projects, for these kinds of investments in many parts of the developing world? Because unless you can crack that nut, then the transition is indeed going to be incredibly difficult.
Thank you very much. So we'll now move into some of your questions and comments. A reminder for people who are here in person, there are cards available, and we already have a number of them, so thank you for that. Also for folks online, we are monitoring the chat function if you want to submit questions that way as well. So Tim, you touched on something that actually would have been one of the first questions, which is your scenarios are built around different assumptions of government policy, and there are certainly differences in terms of technology and significant differences in behavioral assumptions as well. But as you have progressed this work, and I'd invite the panelists to jump in as well, what are the key uncertainties that we haven't touched on yet? I mean, where are we most likely to be surprised? Or, for those of us at the Baker Institute, what are the next big research topics?
It's a great question. I think a lot of the debate now, and particularly in the light of the market turbulence that we've had in recent months, is about what a messy transition looks like. So what happens if the developments are poorly sequenced? What happens if you have mismatches on the investment side of the sort that we've been discussing? What happens if your generation investment moves ahead more quickly than your investment in flexibility or in infrastructure? What happens if technology moves more rapidly in some areas than regulation? Those are the sorts of areas that I think are going to be particularly interesting for us certainly to be looking at.
Yeah, I'll just add, because it's come up, and a colleague of mine and I, along with a graduate student, about 6 years ago, published a piece in the Energy Journal that sort of used the turn of phrase optimal disruptions in energy transitions. And it was really about as you start to transition away from an incumbent towards a newcomer, right? And we were sort of agnostic as to what that newcomer would be, but it means the long-term returns to capital in the incumbent start to diminish in terms of the view of those returns, which means the price has to go up because capital actually starts to get removed from the incumbent sector into the newcomer. If the newcomer is more capital intensive, then that means you need that much more capital to drive the same amount of energy delivery, and so you get a messy transition. And what's interesting about that in the context of what we did is that's actually an economically efficient outcome. Which is hard for the layperson or anybody in the general public or a politician to digest. But it's one of those things that I think we're starting to see a little bit of hints at, some hints at. If we start to see capital migrate away from the traditional fuels, you're going to see more disruption because you're going to still see a lot of volatility in demand related to economic growth and other things. And it's going to be a little while before other technologies can really step in to fill that void. And so you're going to see higher prices, you're going to see volatility. It's really an issue then of how palatable is that politically. And I would argue it's not. We've already seen evidence of that, right? So that in and of itself can be disruptive to the pace of transitions.
What I would add to that, a glimmer of hope, is that there are emerging technologies that are real needle movers. So for example, and if any of you have read Bill Gates's recent book, if you haven't, I commend it to you. It's actually very good. He's focused on compact nuclear fusion as a real needle mover as it regards the ability to replace kind of baseload electricity demand or supply away from coal and natural gas and towards compact nuclear fusion. It also has broader applications in other areas. There are a lot of folks who believe we are within 10 years of having commercial compact nuclear fusion plants that work. That's a bit of a game changer. So I don't think we should be so quick to dismiss the fact that in a net zero scenario, it's going to require a bunch of technologies that don't exist today, because there's a lot of interesting work on those sorts of technologies underway. That being said, back to Ken's point, even with those new technologies, infrastructure tends to really matter. and so any technology that can leverage off of our current infrastructure is much more likely to be adopted more quickly and thus have greater impacts.
So I just want to say one thing, because we often forget how radically innovation can change the status quo. And we're just on the back end of living through one of these things. I mean, you think about shale, right?
You beat me to it.
Yeah, I mean, you go back to the 1980s and nobody thought shale was ever going to be a commercial reality. Then in the early 2000s, there was some experimentation done, largely because gas prices rose, so high prices beget a lot of new things. But the natural gas price in North America between 2003 and 2006 was higher than anywhere else in the world. And that's also the same time in which George Mitchell started to experiment in Barnett up in the Fort Worth Basin. And so that was unlocked, and it radically changed the global oil and gas ecosystem in a decade. So innovations, if they can actually come to fruition, can be game-changing very quickly, but I will note that actually leveraged existing infrastructure.
Right.
Sorry, Mark, can I come in on?
After you, Tim.
I think this technology issue is incredibly important. And I just wanted to, you mentioned up front a finding of ours that half of the emissions reductions to get to net zero come from technologies that are not readily available on the market today. So they're still in the demonstration or prototype phase. So I completely agree. There's a sort of twin challenge here. We need to run very hard with the technologies that are already mature and there are low carbon technologies that are already least cost in some areas, notably in power generation. And there is much more that we could be doing on efficiency that is cost efficient as well. But there are areas, particularly in the industrial sector and long distance transportation, where we don't have all the tools we need. And that's where we don't need breakthroughs in basic science, but we just need that virtuous circle of assistance, deployment, innovation, creativity to get those technologies moving. And that's things in the clean hydrogen space. It's things in elements of carbon capture, utilization and storage. It's some advanced biofuels, and it's areas such as direct air capture.
Thank you. Yeah, in terms of how quickly technology can move and surprise us, I would merely note that Ken and I met less than 20 years ago working together on a study that advised the Secretary of Energy to build a lot of LNG import terminals. and thankfully our careers survived that effort. So a couple of questions have come in along a particular thread. I mean, Tim, you mentioned a couple of times actually in your presentation, well, giving governments the benefit of the doubt. We're going to look at the various pledges scenarios, and some of the questions have come in of saying, what have governments done since COP1 to earn the benefit of the doubt, and what are the costs of failure, and is anybody looking at failure scenarios as well? So
I think there's a lot of work done on the costs of inaction. So the costs to the economy, the costs of failing to address the climate challenge. I think that if you look back at the record of governments in meeting their commitments, of course it's a mixed record. And that means that some people look at our scenarios and they look at that announced pledges scenario and they say, well, by and large, governments don't deliver what they promise. Therefore, my expectation for the trajectory to 2050 will fall short of that line. But on the other hand, you could easily counter that with some of the comments that have been made just now by Ken and Bobby about, but we will have time to innovate. We will have time to bring down the costs of some of the technologies that are not perhaps readily available today. And we will also be faced with the urgency of the situation, the increased physical impacts of a changing climate. And that will also have an impact on the public debate. It will have impacts on policy as well. I think what we need to be aware of is that there will be pressure on governments to act, and to act in a way that's commensurate with the dramatic nature of the situation. There is a risk that some of those actions will be misplaced, that in the drive to bring down emissions, you may prematurely remove parts of the system that are actually very important for security of supply. So I think that's another risk we need to be aware of.
Mm-hmm. Following up on the supply question, there have been a couple of questions around the assumptions around investment and the U.S. and North American production profile, especially in the net zero scenario, Tim. I mean, when you say no new, I want to make sure I get the phrasing right, but sanctions that are already in existence or approved, how do you how does shale fit into that? In terms of what are the assumptions around future shale development that feed into that assumption? And on a related note, how you also show in the net zero scenario, that Middle East producers grow their market share dramatically, and I'd be interested in your views and the panelists on what changes need to take place, because that's manifestly not where the group is now. Today, as we speak, the OPEC Plus group is withholding almost 4 million barrels a day of supply from the market to support prices. And so that's a 180-degree, strategic, stance from what is proposed or assumed in the net zero scenario. And so what has to happen to allow these countries to get from here to there?
So first on the shale question. So let's be clear about the way that this net zero scenario is set up. It is driven by changes on the demand side of the equation. So governments put in place policies, incentivize investments that allow for mobility or demand for mobility to be met by sources other than oil, or to use that oil much more efficiently, and the same across other sectors of fossil fuel use. And that means that these demand falls very rapidly. Now, the conclusion then is that if that happens, then you can meet that demand from existing fields or from fields that have been approved for development as of the end of 2021. Of course, shale is difficult to fit squarely within that way of looking at the world, because the notion of a field obviously doesn't quite tally. So we do have continued investment in existing shale basins. But overall, that continued investment is not enough to obviously offset the implications of declines at individual wells. And so within a few years, you start to see that source of production tailing off. Now, in relation to the Middle East, you have obviously some of the big resource holders, they have a cost advantage. But this is a scenario in which you're not developing new fields. And so it's essentially a game around decline rates and the investments that you can make in order to slow those decline rates. And it's simply the case that in some of those large resource owning countries, decline rates are slower. It's the nature of the fields dictates that. And so they end up in that scenario with a higher market share. Now, of course, that creates huge strains on the institutions, on the way that the development models of many of these producer economies. So the revenue that they get from oil and gas falls quite dramatically. And so that increases the already evident urgency of trying to bring a more diversified economic model into some of these economies.
Mark, I might make a comment or two just about shale and the U.S. from my perspective as an investment banker in this space. And this sort of ties also to the sort of future of Houston as an energy, as our own little mini petro state, if you will. Between, call it 2008 and 2018, U.S. onshore production or U.S. production in general moved from about 5 million barrels to 13 million barrels. So an unprecedented amount of growth, the vast majority of that being, of course, shale. And within shale, the vast majority of that being in Texas, and in particular in the Permian Basin of Texas. Houston in our region was the great beneficiary of that boom. We were the fastest growing major metro in America by some meaningful amount over that period of time, and Dallas was second. So it was an unprecedented period really in our history, and we were the beneficiaries. It's hard to imagine a scenario in which we take 13 million barrels of U.S. production and grow it by similar amounts over the course of the next decade. We think there are parts of shale that are likely to grow in terms of daily production. The Delaware Basin and the Midland Basin in particular are two areas that we think can and will. But in the aggregate, we think that's highly unlikely. So more or less, we would expect U.S. production to be stagnant over this period of time. And we would also expect efficiencies to continue to improve, as they have improved pretty dramatically. We are producing more, for example, today in the Permian Basin than we were in 2018, with about 20% less people in the business. And so if you use employment as a proxy for economic prosperity, you would look forward and say, well, it's highly unlikely that we're going to generate a bunch of job growth associated with this incumbent business in our region here in Houston going forward. And thus, we think it's really, really important that Houston leverage its existing strengths and build a position in leadership in a lot of these new areas of energy. And we're off to a good start. There are some where we feel like we have real structural advantage, like CCUS and hydrogen. And there are others where we know do not necessarily have a structural advantage versus others. But we would agree in general that the outlook for the hydrocarbon business in the U.S. is flat ish for some extended period of time. When that starts to decline, will be tied, as Tim suggested, to global demand numbers. We like our ability to compete on the cost curve, and so we think Permian Basin production in particular is very competitive with most anything in the world, perhaps outside of a few fields in Saudi Arabia. But as it regards growth, we think it's very unlikely that we would have much.
So I'll just add one thing to that. It's interesting to listen to Bobby talk about the outlook for the Permian and Texas in general. If you take away energy transitions, you're really just talking about something that moved from a high growth prospect to something that's now becoming a mature industry, right? And so I think I agree 100% with that. The one thing that I think is interesting is, there's an old saying, necessity is the mother of invention. And when you think about Middle East countries and oil-rich regions, there's a lot of R&D that's going on in terms of trying to figure out how to transform hydrocarbons into zero carbon fuels. And in some places around the world, there's a lot of interest in something called the carbon to value proposition, which is, you think about capturing CO2 or solid carbon, depending on what you're doing, and turning that into a high value material as an intermediate product. So I think as we look forward, I think the world is wide open. Without a doubt, decarbonization is at the central of what a lot of people are thinking in terms of strategic planning, but I think well-placed R&D is going to transform this conversation in major ways over the next 20 years.
Right. Absolutely. Well, we are almost out of time, and so thanks to your inquisitive and curious nature, both the team folks online as well as here in person. The good news is that we've had a great conversation. The bad news is that we didn't remotely scratch the surface of the topics that you had on your mind. More good news is, don't worry, this won't be the last conversation we'll have on this topic. Thanks, Tim, to you, as well as to Bobby and Ken for a lively and insightful conversation. We've covered a lot of ground today. It's fair to say, I think, that we've raised more questions than we've answered, and I have the proof of it right here. That's okay. One of the key takeaways for me is that we face enormous uncertainty. Just in Tim's scenarios alone, the high-low range for world oil demand in 2050 is 75 million barrels per day. And remember, that's only with one net zero scenario. There's an infinite number of potential successful outcomes here, that we haven't gotten to yet. So we have to approach the energy future with some humility. And as many of you who have suffered through our events before have heard me say, there are no facts about the future. But uncertainty is no excuse for inaction. Rather, the conversations we hold are to help us to understand the key uncertainties and the factors in which we do feel like we have some confidence. To understand the interplay between policy and technology and economics and preferences, as well as the interplay between environmental and economic and security policy prerogatives. And finally, interactions between governments, companies, and individuals. Each of us has a role to play in this. The recent sharp increases in energy prices here in the US and around the world are a reminder that fossil fuels and zero carbon applications are not an either or. It's an and. We need to ensure sufficient and affordable energy to run the world's economy and the US economy today, and we need to pursue a rapid transition to a lower carbon future. As Tim noted, the risk is that we face a very volatile future indeed if we don't pay enough attention to this balance. Getting a better handle on the role of oil, the world's largest form of energy, in this transition is essential in threading that needle, in making sure that we have enough available, affordable energy today and, a successful, hopefully, and a more sustainable energy future. So we look forward to continuing this exploration and conversation with all of you. Thanks again for your time. I hope you all enjoy the holidays. Best wishes for a happy and, in the COVID era, healthy 2022. Please join me in thanking our panelists.